Hello and welcome to Money Talks COVID-19 Daily Bulletin for Wednesday, April 1st. My name is Anthony Okolie. In a few minutes, we'll be speaking with Greg Kasich. He's the head of the High Yield Bond Group with TD Asset Management. But first, a wrap of today's market news. The White House warned that up to 240,000 Americans could die as a result of the coronavirus pandemic. President Trump said that the US should prepare for a very, very painful 2 weeks from the rampant coronavirus. Ottawa will have the ability to set up a corporation to buy troubled assets from banks or other companies if necessary to stabilize the economy. The action would only be employed in a worst case scenario. Canada's March manufacturing PMI index fell to 46.1 from 51.8, signaling a contraction as the coronavirus hits the economy. Similarly, the US March ISM manufacturing index also indicated a pullback, falling to 49.1 from 50.1 in February. UK's largest lenders, including Barclays and HSBC, have scrapped dividend payments to shareholders, as well as share buybacks. Regulatory pressures has been mounting on UK banks to free up capital during the coronavirus crisis. And finally, iconic retailer Macy's was dumped from the S&P 500 after the company shed more than 70% of its value since the start of the year. HVAC equipment maker Carrier Global will replace it in the S&P 500 on April 3rd. Fears of the coronavirus pandemic have disrupted credit markets, sending volatility and spreads dramatically higher. But my next guest believes that there's still some opportunities to be found despite the sell-off. And here with more is Greg Kasich. He's the head of the High Yield Bond Group at TD Asset Management. Greg, thanks for joining us.
Great to be here.
Greg, we've seen growing concerns about corporate cash flows during the sell-off. What's been the impact to credit spreads?
Well, the credit spreads have widened significantly over the last several weeks, and reflecting the concern that the credit quality of a lot of companies will be lower, will be worse, given the shutdown of the economic activity. So, what we've seen is high yield, which last year was trading at around a spread of 400 basis points. That's 4% above the government bond yields. Now that spread is close to 1,000 basis points or 10%. So it's been a very, very significant widening, and more importantly, it happened in a record amount of time. It happened like in 2 weeks, less than 2 weeks.
And what's been different about this sell-off versus the 2008 financial crisis? What's the difference here?
There's several differences. 08, we were going into 08 with very stretched balance sheets of the consumer, with the housing market sort of out of control and really mismanaged in terms of how the mortgages were being originated. So the consumer was leveraged. The banks, the financial system was leveraged itself. And we know that several of them really were running unsustainable business models, and they were kind of at the center of the whole financial system, the Lehman and others. And the corporations were in a reasonable shape. What we're seeing right now, going into this health pandemic, is almost the reverse. We've got consumer with very strong balance sheets in US going into this. We've got banks with strong balance sheets, very good buffers, capital that they have available. And the overall financial system is actually not significantly leveraged. The corporations, though, the one thing we have to remember, the corporations, the actual industrials, are a little bit more leveraged than they were in 07. So you've got a little different situation. I think taking all of this into account, the system today is much, much stronger than it was back in 07, 08. But of course, we have never faced this kind of a pandemic before.
And certainly we've seen central banks around the world, including the Fed and Bank of Canada, cutting rates, providing unlimited liquidity. What are your thoughts? Have they done enough to support the markets?
They've done a lot. The particularly US has actually done quite a bit. And I think there's maybe more coming. And really, at the end of the day, it's all about managing the confidence of market participants. And obviously, the managing of the confidence of households as well as corporations. So one thing you can do as a policymaker, as the central bank, or as the government itself, is provide backstop for certain for certain groups in a society, whether it's the individuals or it's the businesses or even some financial institutions. What I mean is you don't actually have to provide necessarily subsidy. Sometimes you do have to, and we've seen that with wage subsidies and things like that. But you simply provide a backstop or a promise that you will be there as a government or lender of last resort in case somebody has a problem rolling a credit line, just because the economic activity has been shut down for the next several months. So I think there's a little bit more to come, but I think a lot has already been done. The amount of initiatives and stimulus is pretty much unprecedented. So I think we've used quite good tools so far, but I think the government has a lot of many other tools to use in the future.
And I want to touch on some of the sectors which have been affected disproportionately by the outbreak, for example, airlines, the oil sector as well. Where are you finding opportunities during the sell-off?
We find that those sectors that were directly hit, like travel and energy, they're actually very difficult to really execute right now in terms of executing on investment ideas because of first of all, the volatility is extreme in those two sectors, and the outlook is extremely uncertain. I mean, we don't have a rule book at all. Like we've never had anything like this happen before. You can look at 9/11 a little bit in terms of how it impacted travel. You could look at energy downdraft that we've seen many times in the previous cycles, but we've never had such a shutdown of activity on such a scale globally. So those two sectors, I would say we're looking at it, but I think it's very, very tough to execute. Where we do see a lot of great ideas is defensive sectors like cable companies, telecom, wireless companies, certain parts of the media space, the businesses that have very strong business models, no matter what sort of environment they are in, and particularly today, where everybody is highly dependent on online connections we're using right now. It's those types of businesses that have also sold off with sympathy with travel and energy. Maybe didn't sell off as much, but they did sell off quite a bit in high yield. So that's where I think a lot of opportunity is.
Okay, and we only have a few seconds left, but just want to ask your point, get your views. What should you say to investors that are anxious about having some exposure to high yield bonds right now?
You have to be careful when you're buying high yield bonds. I mean, even in the best of times, you're looking at a market that may have 1 or 2% of the companies defaulting. That's in the best of times. Yeah, you may be getting paid 6-7% for the risk of the 1 or 2% default, which is nice. But if you don't do the right selection, your portfolio could be impacted. In a recession scenario like we're looking at right now, we could have a default rate, 8-9% of the whole market. So you have to be extremely selective. You have to look at high yield as a 2-year or 3-year type of investment, not only because the cycle may take a while to play out. I don't think, by the way, in this case, it's going to be that long. But normally, you really need to be looking at a 2-year investment commitment because both the credit quality as well as the market conditions themselves, they take a long time to play out in high yield. The liquidity is a little bit lower in this market. So to properly really manage this sort of investment exposure, you need some time. And I would say the best advice I can give is look at the companies themselves that are issuing those bonds. If you do buy those indices or portfolios, look below the hood and what are those companies? Can they sustain 30% drop in revenue over the next 2 years? And I think that's what we're doing. We don't worry too much about prices moving up and down every day. We think about it all the time. We're trying to manage that. But more importantly, we look at companies that issue these bonds. Is this a cable company that has subscribers that actually are clamoring for service? Is this a food delivery company that doesn't have a problem here? Or other situations. So, that is the backstop here. Like if you see a business that can manage its leverage over a cycle that may reduce its revenues by 30%, then I think you're fine. The prices of bonds may fluctuate quite a bit, and that may be unnerving.
Greg, thank you very much for your time.
Thank you.
And thank you for joining us. My name is Anthony Okolie. Please join us again soon. Stay safe.